Okay, we're going to start today by looking at our stock market calendar. There is something called seasonality when you're investing, and the stock market follows um, about 80% of the time the same seasonal patterns. Right now we're in October. October, this is like I think I think the stock market follows the East Coast weather timeline. So, in other words, whenever it's winter and it's not so great outside, like in January, February, March, the weather isn't so great. You know, we're waiting for spring. People on the East Coast, which majority of the stock market participants are on the East Coast, they actually um, have bad weather. So it's not until April where we have non-freezing weather and people are getting out. And that's might be because that might be the reason why we have good performance in the stock market then. And it's the same thing with the end of the year. We have better um, better weather towards the fall season. That being said, we do have seasonal patterns. The stock market returns negative amounts over time in August and September. And that actually was what happened this year. September was a really bad month. And October is traditionally one of the best months. October actually is a month when earnings come out. And um, earnings come out 4 times a year, once a quarter. So every 4 months, we have the stock market that can be could go up because of the earnings reports. So right now we're at the beginning of the earnings reporting season. So right now the banks started reporting in last week, and this week we're starting to have earnings reports for the banks come in. And next week and the week after, we're going to have tech earnings such as Microsoft, Amazon, Google, and those usually have a positive influence on the market. So right now, the interesting thing about the stock market is we are overbought. Now, the stock market at any point in time can be oversold, which is when the stochastics are down at the bottom, or it could be overbought when the stochastics are at the top of our range. So you can see how this is like a sine wave. Whenever the stock market is overbought, this is the SPY, it's the S&P 500. So right now we happen to be overbought. That means majority of market participants have been buying, and we've gotten to a point where we're classified as overbought. Whenever we're investing and buying a little bit at a time, we try to do so in a way that's managing this overbought and oversold mentality. So whenever the stock market is going up in a channel like it is now, this is the S&P 500. Whenever we're at the bottom of the channel and we're at the bottom of the stochastics, that's the time you want to buy your stock or index. When you're at the top of the channel and when you're at the top of the stochastics, that's the time you don't buy, or that's the time you sell if you have something to sell. For me, I'm a buy and hold person. Now, these are my theories. It might not work for you. It's worked for me, and it's been pretty accurate. This is what's known as slow stochastics. You can get this by looking at Yahoo Finance and looking at the chart there. Okay, that's a great little review. So we do have the seasonality. The last 4 months of the year, last 3 months of the year are traditionally positive. There's a lot of reasons the seasonality is good this time of year. One is we have holidays. We have Thanksgiving, Christmas, New Year's packed into a short amount of time. And we have good weather in the East Coast. That's all pretty important. And we have earnings. So October is usually packed full of earnings. And then we have earnings come out in January. and then again in April. So that's why, and a lot of times earnings, when they come out, people get excited about good earnings reports and they bid the stocks up. And whenever you don't have earnings reporting season, such as June or July or February or March, there are just no catalysts for the stock market to go up, very little. And that could be because the reason why it's lackluster performance over time. So that seasonality, you can see February isn't that great of a month. And then you have June. Earnings are not coming out in February and June, nor are they coming out in September. All right, so that's good to keep in mind. Now, what we're going to do is we're going to look at some of the catalysts for markets going up and going down. We look at this every week and we add to it if necessary. Right now we have interest rates are a very important part of investing, because interest rates, as they go up, that makes, whenever interest rates go up, that gives an investor more options for secure returns on their money. So right now the 10-year and 2-year haven't been doing anything. They're basically unchanged to down in the last week. And that is good. That is good for the stock market, because there is a fear that if the interest rates keep going up, people will pay less for stocks, the multiple that they're willing to pay for stocks. And we've been in a Fed tightening schedule where they're raising interest rates for at least a year now, and that has a year and a half, and that has made stock markets a bit on the edge right now. Okay, so we also have, for the catalyst for markets to go up, usually a dollar going down, dollar declining is good for multinational stocks. But right now it's actually strengthening. So that's going to be bad for all the multinationals reporting this week. So we have a couple, we'll go over it later on, a couple of variables that are taken into account of why, in general, the stock market will go up and down. One reason for the catalyst for the market to go down is interest rates going up. We also have a rise in U.S. Treasury yields and any kind of international problems like China property market. So let's look at some of the, let's see. Okay, we're going to look at the lines for the S&P. This is the charting pattern for this week's S&P 500. You can see that for the past year, we've been very, very consistently following this channel. And I made this channel just by drawing the bottoms of this chart and the tops of each of the items right here. Here's the top, here's the top, here's the top, here's the top. So I drew that, and basically this has been following that channel up. One of my theories is once you break out of this, there's a possibility we might be forming a new pattern here of lower highs, lower lows. And if we do break out of this, then chances are we're going to be going down here in a month or two and establishing a lower low. But right now, for now, we are still in an uptrend. And that's momentum for the entire stock market. Right now, we're overbought. So there's a very good chance that the stock market will go down whenever we've reached an overbought state. So you have to keep that in mind. Part of my strategies when investing is to put a little bit of money in at a time so that you can average out the cost of your purchases. Right now, I don't have a whole lot of money to invest. So if I have $100 or $1,000 to invest, I want to put that capital to use whenever we're oversold and we're at the bottom of a channel of when we're investing. So we want it to be oversold and at the bottom of a channel. And that's just a simple way that I've used to put money in whenever I have to invest it. I definitely don't use it to buy and sell and get in and out of stocks, because that's it's really hard to win when you're trying to time the market. All right. So what I did was I put together a list of all of my theories for investing. This has worked for me. I've gotten returns of 12.5% over time for the past 12 years. So on average for my entire portfolio. So I have things that have worked for me, might not work for you, but basically when you're investing, you have to do the opposite of what normal convention is. And it's kind of hard. It's called contrary investing, and you have to have a set of rules that you follow, and you have to be willing to buy when people are selling, and then when people are selling and they're fearful, you have to be buying. So Warren Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." I follow Warren Buffett a lot, and I try to follow the way he chooses his investments and buys and holds for a long time. So we go over something called the fear and greed indicator every week. And sometimes it's extreme fear in the market, and then there's sometimes it's extreme greed. So whenever we're fearful, that's time to start looking to buy something. When everyone's greedy, that's when things are overbought and you don't want to buy. So I get ideas of stocks to buy and hold from mutual funds, hedge funds, and really smart people who show us what they're currently holding. Hedge funds and mutual funds usually return around 12% per year, and they don't like to turn over their holdings, and they get penalized. I mean, there's something called the turnover on a mutual fund, and if it's too high, investors don't want to invest in it. So they try to do the research and buy and hold good stocks. So part of what I do is I look at the holdings of top mutual funds and over years. So in the year 2021, I compare that the holdings of a mutual fund from that time to now, and I see what has changed and what has not. That gives you an indication of what works for some of the best mutual funds in the world. So when buying stocks, buy stocks that reinvent themselves or have a consistent product over time with a high demand. Warren Buffett was famous for buying the company Gillette. This is back in the 80s or 90s. And Gillette, his theory was people are still going to be shaving 20 years from now. So there's a constant demand for those kind of products. So a lot of the stocks that we're following, like Apple, they have a steady demand for their services, like the App Store, and that's growing. And people are still upgrading to the latest iPhone. So 20 years from now, we don't know if there's going to be an iPhone. Maybe it's another type of mental telepathy headset that they're selling. But whatever they're selling, we know they're constantly reinventing their company and the products, and they have 1 billion active users. So that's an example of a company Warren Buffett has as his top holding, and something that I believe in, and it's one of my top holdings too. So when you sell a stock, you have to pay capital gains on the sale. So it's your best interest to buy and hold stocks for the long term. And there are several variables affecting what people are going to pay for stocks. We go over these in our talk every week, because it's just like variables in the computer program. We know that certain variables are going to affect the stock market, and we have to keep track of those variables. The variables, for the most part, are out of our control, such as the price of oil, such as the interest rates, such as consumer demand, So we have to keep all these in mind and know how these, I mean, we have to keep track of these variables and over time prove to ourselves these do affect stocks in a certain way. And when we see the price of oil going down or the interest rates going down, we can be a better investor and buy different things that could be good in that environment. Okay, so here are two examples here. Oil is very important. The price of oil actually determines, it's one of the biggest costs of businesses. So when you're transporting your products to be sold, that's done using oil. And whenever you're making oil, products such as plastic, they're made from oil. So as the price of oil goes up, that adds to the cost of doing business and creating your products. So that makes your prices that you charge. I mean that the cost of making your products go up. So the amount of money you make per product sometimes goes down. So that's bad in general for the stock market and for companies. When interest rates go up, but it's good for oil companies and oil service companies, a lot of other companies that do good when oil goes up. There are companies such as FedEx Airlines and cruise lines that have oil as a high input cost to their business model. And whenever oil prices go up, we know that the airlines, UPS, FedEx, they're going to have a higher cost of doing business and not do it so well. Interest rates is another example. When interest rates go up, it affects the whole economy more than any other variable, because interest rates determine how much you pay for mortgages, how much you pay in a credit card debt, how much companies have to spend to borrow money to grow. So the smaller your company is, the more you rely on money, borrowing money to grow your company. So we've been focusing on large cap companies in this talk because they're a little bit more reliable. They don't require as much money to borrow. And therefore, in this kind of environment, it's they're not as affected by higher interest rates. So people are willing to pay less for stocks as interest rates go up. So the reason for that is if you can get a 7% yield on a treasury or interest, then you might not want to buy a stock that yields 7% and has the possibility of going down. And okay, so that's just an overall view of my theories of investing. So we're going to go over a couple major variables in the stock market. We'll go over these every week. The price of oil is up 6% in the last week. So usually the price of oil reflects demand for oil, the global demand. And it has to do with supply too. So if there is a cut in supply, such as if there's a war in the Mideast, that will reduce the supply and that will increase the cost of oil. Or if there's a global recession, that means the economies around the world in general are going down and are in a recession, then there will be a lack of a demand for oil. So that will make the price of oil go down. All right, so the other thing is inflation. Right now, currently, the inflation rate is 3.7%. So it was 8% last year. So it is going down. And inflation, as inflation goes up, the amount that consumers pay for products goes up. And the amount that they can spend, basically their spending power goes down. So the economy is likely to contract as inflation and interest rates go up. We also keep track of what's known as the U.S. dollar index. It's a measure of the strength of the U.S. dollar against the basket of other currencies. So as the U.S. dollar index goes up, the profitability of multinational companies go down. For instance, Apple has half of their sales overseas. If the US dollar goes up, then half of their sales are going to be repatriated, it's called, into America at lower costs. So they'll make less money on that 50% of business they do overseas. And the earnings report, this earnings reporting season starting next week with the tech stocks, we're going to see that the US dollar is affecting their sales in a negative way. So we have to be ready for that. For me as a long-term investor, I know this earnings report is going to be kind of difficult for the large cap companies, but next month it might be affected a different way. And you have to understand as a long-term investor, you have to look at their constant currency growth and kind of ignore the US dollar indexes if you're not going to be buying and selling every month. Okay. We review this fear and greed index every week. This is a CNN calculation of the investor mindset. And right now people are fearful. And why are they fearful? They're fearful a couple different things. One is interest rates being raised. And whenever interest rates go up, people are afraid of buying houses because the mortgage rate is going up. The economy, companies might not be growing as fast because it costs more for borrowing money to grow their companies. So people are fearful right now. And a lot of times in October, some of the biggest crashes in history in the United States happened in October. So there's just a little bit of fear. And we were extreme fear last week. And so we keep track of these because when you're extremely fearful, this is the time when you start looking for bargains. If you're not invested and you're looking for something to buy. When they're extremely greedy in a stock market, the chances are we're overbought. People are excited and they're bidding up stocks. And that's not the time you buy. That's the time you either sell or don't buy. All right, so here's an example of a chart of the US dollar. For the past couple years, we've been in a downtrend, which has helped all of the big tech stocks because it adds like 10% to the earnings whenever the US dollar goes down. But lately, since July, we've been in an uptrend in the US dollar. And this is in direct correlation to how our economy is doing, what our job market's like, and basically the strength of our economy. And 50% of the Magnificent Seven earnings come from overseas. So as this dollar goes up in value, the amount that the Magnificent Seven earn is less. So every one of the stocks next week that's reporting are going to say we had some problems with currency conversion, which they might be 10% less profitable. But you have to keep in mind all these things whenever the stock reports and they say they earned 20% less than they could have and they drop. You have to say, well, that's either something you have to pay attention to or not. But it's a variable that's involved in how profitable companies are. And that's something to keep in mind. Now the VIX is it's a way to track how fearful the market is, and it's calculated using the amount of puts versus calls in the market and a couple other ways. But it's been going down, so people are becoming less fearful of the stock market going down. So right now it's at 19. That's really low. When it's at 30, 32, people are panicking, and when it was 12 about 2 weeks ago, people are very aggressively bullish and they're excited about the stock market. So right now we're still in a non-fearful mode in the VIX. what I did is I put together this. This is a very common way to look at emotions when you're investing. And the key for this, most investors, when they start investing, they whenever people are greedy and whenever you have media attention and things are going up, the normal person getting into the stock market wants to buy. Everyone else is buying, it's time to buy, but you got to think in an opposite way. Whenever you have people saying AI is a new thing and people are bidding up stocks, you have to be on the other end of things and saying, I'm not falling for that. And whenever people are fearful and people are selling and there's capitulation in the stock market, you have to be on the other side looking for bargains to buy. So right now we're actually, in not a capitulation mode, but we're in a fearful state where people are wondering what's going to happen next. I listed a couple of things that could cause the market to capitulate, meaning everything goes down and people are super fearful. We haven't had that sell-off in a long time. And what I do is I put together some things that could cause that, and we'll see if that ever happens. Right now, some of the biggest problems in the history of stock market crashes is because of debt. Whenever you have over-leveraged situations where companies or people or countries borrow money and they can't pay back their debts, and then there's a crisis. Right now we have a couple possible issues. Chinese have a real estate crisis. They have a company called Evergrande, I think, that's real estate. They went bankrupt. There's some banks that might be failing because of that. And there's a lot of, Fitch downgraded the U.S. debt. So that could lead to higher treasury rates. That was about a month and a half ago. We have a lot of stocks that are in a bubble in America, such as NVIDIA, a couple other stocks that are AI companies. If any of those start correcting, that could lead the market down. Right now, consumers are wrecked. They are spending, and they have a lot of credit card debt. If they start defaulting on their credit cards, loans, that could cause a major problem. We have people working from home now, so commercial real estate is not being used. And if the people that are managing these commercial buildings and there are no tenants, there are issues where they might not be able to pay their mortgage. So we also have higher gas prices and overpriced expensive stocks. So those are the things we have to worry about. Right now, we don't have a crash or a correction. We just have a normal uptrending market, which is pretty good for the stock market. Okay, so we have, I found every week we have articles that I come across that kind of validate or confirm some of the things that I believe. I follow Charlie Munger and Warren Buffett. They are the ones that run Berkshire Hathaway. Charlie Munger says the big money is not in the buying and the selling, but in the waiting. High returns don't actually require high effort. So Munger says the big money is not in the buying and selling, but the waiting. Compounding, the power of compounding is pretty incredible. I've been trying to calculate compounding growth my whole life, and I think I've been pretty good at it. My strategy is to buy quality stocks and just hold them over time. And Munger says there's a misconception of effort. They say the more tinkering and frequent trading that you do, normally you would consider that helpful, but it actually isn't. It's you need a well thought out strategy and with patience, and that could be the best thing you can do. So let's look at the other things that validate that idea. You have something that says it's timing the market, not timing the market. That's something that Peter Lynch said. And Warren Buffett says timing the market beats timing every time. So if you miss the best days of a year, this is a report goes back 10 years. This says if you miss the 10 best days of the stock market, you reduce your performance in half. You would normally get 10% by buying and holding the stock market. And if you miss the best 10 days, it's 5% return. And then if you miss the best 20 days, then you get a 3% return. So timing the market's like a fool's errand, and it's really hard to do that. And of course, we can't be day trading because we have jobs to do during the day, and being worried about trying to buy and sell a stock whenever you're working is counterproductive. All right, so what I do on a regular basis, every quarter, every 4 months, you have mutual funds that have to report what their current holdings are. And I sometimes go back to see those same mutual funds and what they were holding 3 years ago, and see what has changed in their portfolio and what has not. Whenever a stock is added to a portfolio, that gives you an idea. That could be a stock that's to research. And if you see enough of this, enough of mutual funds adding or holding the same stock, that gives you a little bit more confidence in buying and holding that stock for your portfolio. These are all stocks that we're following as part of our core holdings for the stocks we're following. And you can see that hasn't changed in 3 years for this Fidelity Blue Chip Growth Fund. The ones that were removed from this fund were Tesla and Visa in 3 years. And the ones that were added were NVIDIA and Uber Technologies. The rest of them, they're listed here, are the same amounts. We do have NVIDIA, but they added 7% positions. So that's a very, very significant addition. So let's go to another example of a mutual fund that I follow. It's called the AQR Large Cap Defense Style Fund. And you can see this company is a little less, they did a larger turnover of their positions. They got rid of Microsoft, Nextera, PepsiCo, Alphabet, MasterCard, and Costco, and they added T-Mobile, Apple, Eli Lilly, Verizon, Vertex. So, but you can see they did keep Visa, Walmart, Procter & Gamble, and Johnson & Johnson. So I've held Visa, for instance, since they IPO'd. That was back in like 2007 or so, 6. And whenever I see, Visa being held by, pretty large companies for a long time, and they're continuing to hold that, I have, just by looking at that, I have a little bit more conviction that I can continue to hold that stock. And I still do my research, but they still do have a moat in my mind, and they're the largest credit card processor in the world, and they have a moat. So, but you can see whenever they add stocks to their top 10 holdings, like Eli Lilly, Verizon, Vertex, and T-Mobile, Apple, you have to say, well, is there any credence to adding this to a new position in our portfolio? And Eli Lilly is one we added this year because it seems like they have 2 blockbuster drugs that are in the process of developing. One is a weight loss drug, which could be the best-selling drug of all time, and an Alzheimer's drug that might be approved this year. So, so I've made this a bigger portion of my portfolio because of those things, and based on feedback I get for some of these new holdings in the mutual funds. So my goal in investing is to make my own mutual fund where I hold the same thing every year, and I'm trying to gain 12%, 12.5% is my target per year. And all right, so what we do every week is we go through some of the indexes, the major indexes of the stock market and every stock that we're following. And what I do is I map out, we have the actual, let me see, let's look at, this is the S&P 500 right here. And what I do is I take a picture of that, and to make this stochastic diagram, that's from Yahoo Finance, I draw a line, let's see, draw a line at the bottom. This is the bottom there, bottom. So I draw a line at the bottom, I draw a line at the top, and you can see any other combinations that I see. Like I do see another possible trend developing right here. And so I do that for every stock we're following an index. And we get to see that, the overbought, it's overbought right now, you can see. And we can see it's right in the middle of its trend, its support lines. So I do that for every stock, every index and every stock we're following. And we get to see, this defense, you was in this sideways pattern for a while. Now it's actually going down into this downward lower highs, lower lows. So you can see that every stock can be traced, can be followed in that way. And usually stocks follow these patterns, that because there are actually algorithms out there that actually keep track of this, and they do their day trading. But we just see it as if enough people follow these charts like we're doing, it becomes reality. And there are some people say this is just, there's nothing to this, but it's worked for me, that's why I do it. So almost every stock or sector we're following follows these patterns. And we try to keep track of it and make sense out of it. And so far, we see some patterns happening. This week, we see the XLU going in a downtrend. Why would utilities, this is the utilities fund, this is a combination, it's an ETF of utilities. Why would it be down when the stock market has been going up? That's because the treasuries have been going up in the past year. So as the treasuries go up, let's say they're yielding 5 or 6%, no one is going to want a 4% or 3% return on a utilities fund when the stock price can go down with it. So there's less of demand for anything high yield now. That's why you have a downtrend in those markets. And that's why it's important to keep track of that variable interest rates in our variable list. All right, so let's look at other charts of interest. We see real estate sector going down. This is the XLU. This is the XLRE. It's the combination. It's the ETF for real estate. Okay, so once a month or once every 2 months, I go over this, what makes a good growth stock for buy and hold. These are basically my rules that I use for my screening, for whenever I review, every week I review the stocks that I own in my portfolio, and I say, does it follow these rules? So when we're doing a screen, we're trying to find stocks that fit a certain criteria. When I buy growth stocks and I add them to my portfolio, I want them to have forward projected earnings in a straight line up, at least 10% growth every year. So these are the actual statistics that I want to see when I'm investing in a stock. And you can do searches for those. Let's do a search for Google, and let's look at its numbers in Yahoo Finance. That's Yahoo Finance. Let's look at the statistics for Google. So we're looking for low total debt, return on equity greater than 12, profit margin greater than or equal to 12. Okay, let's look at that, see if it follows those. We see a PE of 29. Okay, it's going to take its time here. We see a PE of 29. We see forward PE of 21. We like to look at the forward PE. So its PEG ratio is 1.3. That means it's about 30% overvalued. When its PEG ratio is 1, that's fair value. If it was PEG ratio of 2, it was 2 times overvalued. So it's a relatively fair valued company. Its profit margin is 21%. Its return on equity is 23%. So the return on equity is 23, that's greater than 12, that's great. Profit margin is 21, that's greater than our 12 that we need. Market cap is 1 trillion, so that's more than the 50. So this matches all of our guidelines here. And for the growth rate, I have a place I go, it happens to be E-Trade, that lists the growth rate versus the stock price in a chart. That is super valuable. What it does is it lists year over year in the future how this company is going to be growing. So if you divide the earnings for this year by this year, it'll give you the amount grown for that year. What we're going to do is we're going to look at Google's growth rate year over year, just to confirm, this company is still growing. And I do that for everything we're following for us, so we can at least know that's being watched. So we can see the earnings projections for the next couple years are going up in a straight line. This is how much they earn per year. And if we do a calculation, 566 divided by 6.71, that means they're growing 15% between 23 and 24. So if you divide 6.71 divided by 7.87, that's 15% between 24 and 25. So it's growing at 15% a year. That meets our requirement of growth rate greater than 10. It's 15. So that's an example of what I do every week to validate holding a stock for a long term. So that's a little review of that. And let's I reviewed the stochastics. So for each stock we're following, I do make a stochastics chart. And it's a separate document that reviews here it is right here. Let's look at Alphabet's current. It's currently overbought. Look at that, 89. So when it's at 89 or higher, that's like maximum overbought, and it's starting to go down. Whenever it's down here, that's oversold, and you want to buy it when it's at the bottom end of its channel. So you can see it's whenever stocks are in an uptrend, here's the high of the channel, here's the low of the channel. And it goes up in a line usually like that, up. And you want to buy it whenever the stock is at the low end of the channel and whenever it's oversold. And whenever it's at the top of the channel or overbought, you don't want to buy it. So we're right in the middle of nowhere's land in our chart. It could go here next, or it could go here next. We don't know. But if a stock breaks out of that channel and goes down here, then you can throw all this away and we start out to making a new, maybe sideways pattern, or even a lower lows pattern. It starts going down. So let's look at, okay, so that's a good review of how to buy a little bit at a time. And what I do when I'm buying, I buy a little bit at a time. So I would buy a little bit here, and you have to choose what your position size is that you want to put it in at a time. Sometimes when I'm making a position, I could put as little as 1/4 of a percent, and not 1%, 1/4 or 1/2% position, just because I want to get into it, and if it goes down, I'll buy more. But I already have my whole position, my whole portfolio now. So at this point in time, I'm using times when it goes down to buy maybe a small amount of it, maybe $100 or $300 into a position. Okay, so let's look at right now. Let's look at what's going on in the stock market. Okay, we see from our earnings chart, this week we're having earnings reports from the banks. And so we expect a lot of volatility up and down from bank stocks. So we see there's a lot of bank activity in the top 10 going up and down. We see U.S. Bank Corp. We have Bank of America that reported. We have Bank of New York Mellon. So then we have the ones going down the most are some banks, Goldman Sachs. We have NVIDIA. NVIDIA's in the news now because there's talk that they might not be able to sell or expand selling their chips in China. So a lot of times whenever one chip company goes down, other chip companies go down with it. Like Broadcom is a chip company. They might go down. And you can see that, let's see. All right, that explains a lot of the S&P moving up and down. Let's look at, okay, we see today we have a lot of retailers in the top 10. Dollar Tree, we have Ross Stores. What other stocks are here? Okay, so there must have been some good earnings reports from some of the retail stocks. And the ones going down the most, chip stocks. So AMD, you have NVIDIA, all these stocks, Broadcom, they could be affected if they don't have China to expand sales of their chips to. So some problems with having when you're a large company, one of your biggest problems is regulation. And if you get too big, the government might say you're a monopoly and start making rules for you to follow. So there's a lot of companies like Google and Apple and NVIDIA that are big, and if there's some laws that say you can't continue to expand your business, then that could seriously affect, the stock price going forward. So we have that with all the big tech stocks right now. Amazon, they're all being looked on for antitrust purposes, and NVIDIA is another example just today where it might be totally affected by rules the government puts on how they can sell in China. All right, so let's look at, see. Okay, so the stock market is basically flat today. It isn't doing anything. It goes up a lot, it goes down a lot, but it hasn't really done anything. One thing that's been consistent through this whole year is the big tech stocks, they call them the Magnificent Seven, have been carrying the stock market. And they're still performing very good this recently. Google, Amazon, Apple, these are all stocks that we've been following and over time, and we know they're all overvalued, even by a little bit or to a lot. Like Apple's 3 times overvalued, but they're not affected by rising interest rates as much as other companies. So we have all our variables laid out. Let's see, what else do we have to go over here? Oh, I wanted to show some of the, I wanted to show, okay, I wanted to show you some of the, what I used back 10 years ago to buy my first positions at Apple and Google, and how I used this chart right here to map out how much a stock was going to be worth. in the future. What I did was I put together a example of how I mapped out Apple and Google. So if you put 100,000 in Apple in 2014, the current price was $500. The fair value was $738. So that means it was certainly undervalued. So the fair value of my initial $100,000 investment was $140,000. What I did was I put $140,000 into the first calculation as what I have in the market. And if it grows at 13%, which I thought at the time, and it yields 2.2%. So if it grows at 13%, 13% of 140,000 is 25,000. And if I add 10,000 every year, and it yields 2%, that's $2,200. I would end up with something that's worth $177 at the end of the first year. And if you do that for every year, you can see over 10 years, that's going to be $1 million of value for that investment. I did that same thing for Google, where I started with 100,000. It had no yield, but it grew at 15%. And it was trading at 880 at the time. The fair value was 983. So the base, which I thought it was worth when I bought it, was 111,000. So if it grows at 15% every year, that's 20,000 with no dividends, and I contribute 10,000 more every year to that. In 10 years, that would be worth $1 million, around $1 million. So that was my first, understanding of how to do that. I want to show you how I looked at that using the reports that I had at the time. When I looked at Apple, at the time it was trading at a PE of around 9. So you can see at the time, we look at this, you can still look at these same reports. This was back in 2012. It was trading for a PE of between 9 and 16 that year. And I saw that it was normally trading for maybe a PE of 30 for the past couple of years. So I thought it was on sale, like half of what it normally trades at. And on top of that, we had an S&P report, the CFRA, said it was undervalued by 14%. That gave me another indication it was undervalued. So at this time, I actually said, I'm going to put a third of my money into this company. That's not something I tell a lot of people, but that's what I ended up doing because I believed in that, and I believed in the company at the time. At the time, they were making the iPhone 6. And I really believed in that product. So I'm doing these same things when I'm looking at stocks to invest in now. I look at the earnings, make sure the earnings are going up in a straight line. Also, you want to look at the revenue, that it's increasing. And that's and look at the PE ratio over time to make sure that, it's at least in line with the PE ratios of past years. So we can do that same thing for Google in that year. Google had very similar, a fair value of higher than it was trading for. So it was undervalued by 11% according to this report. And in 2012, you can see that Google was growing their cash flow and their earnings in a straight line up for the past 10 years. Around 15% a year. So that's when I bought a big position in Google also, because I saw it was undervalued, and I did some calculations, and I said, well, this is in every, Apple and Google at the time were in a lot of mutual funds. So I had some extra confidence in buying those. But the interesting thing, whenever I first bought them, is they went down from there, and they were a PE of like 9, yet in the year 2012, they continued to go down more. So that's where dollar cost averaging helped a lot. So if you looked this is 2012, This is 2012. Okay, so in the year I can't really see it, but in the year 2012, it was something like right here. And as it went down, I bought more, bought a little bit more, I bought a little bit more, and I bought a little bit more. And that was my entire position right there. And that buying a little bit more at a time is called dollar cost averaging. And that helps you establish positions at a time. My average purchase price is like 1%. If I buy 1% or a 0.5% position in a stock, that's my first position. And I think you have to wait, for your times whenever you think a stock is undervalued and it's, a stock you believe in and has all these numbers. That's whenever you can start establishing positions if you don't have a portfolio yet. For me, I'm just kind of, I bought my positions a long time ago. I'm just following just to make sure the company is still growing and the company and the earnings are still projecting to be higher than they were last year. So you can see Google's still projected to grow at 15% a year. Whenever you have a stock, now I have a stock called Verizon, and Verizon has a lot of competition now, and they used to be growing like 5-10% a year. But now, you have a stock that T-Mobile is taking a lot of their business away from them. And look at this. They're not growing as much. From this year to next year, they have flat earnings. They're not growing. And from 24 to 25, they're growing 1% maybe. So that is primarily why you see like this stock going down. And this is the dividend part of my portfolio. So my biggest concern is they're not going to have it in a downtrend. So if it was going down, the earnings were going down every year. That's a good indication my yield that I'm getting for this is going down. It could be going down. So this keeping track of stocks over every week and see how news affects it, see the competition, see if they still have a moat. That's an ongoing process, but it's fun for me. It's something I do for relaxing. It relaxes me. So that's and every once in a while you have a stock that goes down a lot, and it's one of those stocks that we've been following, and it's a potential stock that you buy and hold for a long time. And lately we haven't had anything like that. We've had some 20% stocks moves, but a lot of times the great stocks, like the ones in the Dow, you're not going to see 20% moves or them going down a lot. But occasionally you do have good stocks that go down, and it's called the baby thrown out with the bathwater. And if that ever happens, we have to look and reevaluate, that if the stock is going to still be earning money 10 years from now, and is it still could it be a core position? And it's the same thing if you own a stock that's selling off 20%, you have to determine, did this stock lose its way? Are they still going to have a viable product and a business in the future? So that's like an second overview of what we do every week here. I think I've ran out of time here, but thank you for attending. And if you have any questions, let me know. And I'll see you all next time.